It's Tuesday, 25th of November, 2025. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every weekday. So let's jump straight in. The Indian markets, well, the theme this week feels like anxiety is expensive.
It really does. Benchmark indices declined for the second straight session on Monday.
Right, the Sensex was down about 0.39%, and the Nifty, it dropped around 0.42%.
And what's crucial to understand here is that this slide, it's not really based on poor domestic fundamentals.
So it's an external shock.
Exactly. The primary catalyst is all external. It's investor caution, over these anticipated delays in the U.S.-India trade agreement. Geopolitical risk is it's dominating short-term volatility right now.
And when you say expensive anxiety, you really mean it. The cost is staggering.
It is. Across just the last two trading sessions, this caution directly linked to that trade impasse wiped out approximately 7 lakh crore in overall market cap.
That is just a huge number for diplomatic stagnation. It makes you wonder what a really negative outcome would do.
It really highlights the sensitivity, and here's where the story pivots a bit. From fragility to resilience, we saw foreign institutional investors, the FIIs, offloading equities.
As you'd expect. The typical global risk-off move.
Right. But at the same time, the domestic institutional investors, the DIIs, they stepped up. And they did so dramatically. They absorbed a huge amount of that selling pressure.
Okay, let's unpack that DII element for a second, because this feels like the real deep dive here. What does it actually mean when DIIs are cushioning the blow like this?
It's probably the single most important structural change in Indian markets over the last decade. FIIs are what we call hot money. They react fast to global news.
Right. Geopolitical friction, interest rate changes, they're out.
Exactly. DIIs, on the other hand, are largely mutual funds, pension funds, and, all those retail investors through SAPs. Their capital inflow is steady, it's structural, and it's just far less prone to panic.
So what you're saying is the Indian retail saver has become a force powerful enough to actually absorb international volatility.
That's it. This counter-cyclical buying from DIIs when FIs are selling, it de-risks India from the mood swings of foreign capital. It's a critical stabilizing force.
A domestic cushion.
A very robust one. And if we look over at the money markets, the story gets even more interesting. The Indian rupee, it actually posted its biggest one-day gain in a month.
Which is pretty counterintuitive given the stock market gloom.
It is. And it's a strong rebound from near its all-time low.
That has to be the central bank stepping in, doesn't it?
Almost certainly. Likely intervention in both the offshore and onshore markets. They're sending a clear signal to speculators that they're going to manage depreciation.
So prioritizing currency stability to keep a lid on imported inflation.
Precisely. And that proactive approach, it also showed up in the bond market. The yield on the 10-year benchmark government security, it eased 4 basis points.
Okay, so borrowing costs for the government got a little cheaper. Why the sudden relief there?
It's all about market acceptation. The Reserve Bank of India governor dropped a hint. He said there's now tangible scope for an interest rate cut based on the latest data.
And when the governor speaks, the bond market listens.
Always. They're anticipating a future shift to lower rates, and that drives yields down right now.
So looking beyond all this near-term noise, S&P Global Ratings gave a medium-term view. They're projecting India's economy to expand by 6.5% next fiscal, FY26.
And then accelerating a bit to 6.7% in FY27. But the real insight is in how they see that growth happening.
Right, it's not just the number.
No. They expect consumption to significantly outpace investment as the main engine. And that ties perfectly back to what we were just saying. It's domestic resilience. It's the purchasing power of the Indian consumer that's really driving the story forward.
Okay, so let's transition from that macro picture to the corporate pursuit of profit. Where is capital actually finding a home and, being successful?
Well, on the corporate side, the Adani Group delivered some pretty solid numbers for the April-September period. Their EBITDA rose by 7.1% year-on-year.
And was that across the board?
Not really, no. The growth was very robustly led by their cement and transport businesses.
Which tells you money is moving into core industrial assets, infrastructure, basically aligning with the government's big push there.
That's the story. Meanwhile, WeWork India is charting a really surprising path, especially given the global turbulence in that co-working sector.
What are their numbers looking like?
Strong, robust double-digit growth in both revenue and EBITDA for the September quarter. And this isn't just a flash in the pan. They expect to see even faster top-line growth in FY26 compared to the 17% they saw in FY25.
So the flexible workspace market in India just buoyant.
Absolutely. It signals a lot of confidence in decentralized business hubs. And speaking of buoyancy, the quick service restaurant sector, the QSR space, is seeing what they're calling a flurry of deal activity.
I've seen that. A lot of investor interest there.
A huge amount. These fast expanding chains are drawing in capital because it's the ultimate bellwether of rising middle class consumerism, especially in Tier 2 and Tier 3 cities.
Now let's touch on a significant pressure point you mentioned earlier, the export pain. Engineering goods exports, they slid a whopping 17% year-on-year in October. That's a serious headwind, isn't it?
It absolutely is. A decline that steep signals a serious contraction in global demand, especially from key markets like Europe.
So the industry's fighting back.
They're in defense mode. They're asking for specific carve-outs, for tariff relief, in ongoing free trade agreement talks with the EU. They're just desperately trying to protect market access.
So a major global headwind. But it seems like the domestic consumer is stepping up to compensate. Credit card spending was up nearly 19.6% year-on-year in October.
Right, and that spike was heavily driven by e-commerce sales and festive season buying. It just confirms that the consumption story inside India is far from over. It's providing a crucial offset to that export decline.
Let's shift our focus globally then, starting with energy markets, where oil prices pulled back a little.
Yeah, Brent crude futures fell about 0.9%, and WTI was down about 1%.
And what's the story behind that move?
It's a classic case of investors balancing two competing narratives. On one side, you have hopes for potential Ukraine peace talks.
Which would reduce the geopolitical risk premium.
Exactly. And on the other, there's this sustained optimism about a Federal Reserve interest rate cut, which would stimulate global demand. The market is caught between those two forces.
And those Ukraine peace talks sound incredibly sensitive. Sources are saying the U.S. is pressing Ukraine to agree to terms with Russia.
Yes, and the reported terms are, well, they're tough. Ukraine ceding eastern regions and significantly cutting its army size.
The reporting suggests the U.S. is really trying to force an end to the conflict before winter sets in.
But Ukraine, predictably, is protesting these demands. You can see why. It's an excruciatingly complex diplomatic chessboard where military reality on the ground is dictating everything.
Indeed. Let's turn to India's own trade diplomacy. On the Canada front, things seem to be warming up.
They are. After a recent meeting, both sides have agreed to accelerate trade talks. The target is ambitious. Double bilateral trade to $50 billion by 2030.
Which signals a major de-escalation after a period of pretty serious strain. It's a practical, economic first move.
It is. Now, contrast that warming trend with the firmness being shown towards China. India served a démarche to Beijing.
And for our listeners, a démarche is a formal diplomatic protest. What was the reason?
An Indian woman from Arunachal Pradesh was detained during transit in Shanghai. Officials there reportedly told her that her Indian passport was invalid.
Wow. That's not a bureaucratic mix-up. That's a direct challenge to India's sovereignty over Arunachal Pradesh.
It's a very strong signal. India is making it clear it won't tolerate that kind of diplomatic harassment, especially around sensitive border regions.
And just briefly on global capital, high-net-worth individuals are still seeing the UK as, well, hostile ground.
That's right. Lakshmi Mittal is reported to have left Britain for Switzerland and Dubai ahead of the Labour government's anticipated tax hikes.
It's a continuing trend, isn't it?
It is. We talk about borders and sovereignty, but capital, well, money simply votes with its feet. It's a reminder that governments compete globally for resident wealth.
All right, onto the technology frontier. The global race for AI dominance is really reshaping how money is being invested.
It is. We have a new venture capital partnership focused entirely on the Indian AI ecosystem.
This is Excel and Google.
That's the one. They're teaming up to co-invest up to $2 million in early-stage Indian AI startups. It's crucial seed money, signaling long-term faith in Indian talent to drive global AI innovation.
And what's fascinating is the reaction inside India's global capability centers, the GCCs. They're facing a huge AI talent crunch.
So they're just training their own people now. Instead of hiring external specialists, they're building their own talent supply chain.
It's a necessary move, I suppose.
It is, given the limited external supply and their really aggressive AI adoption deadlines. You know, over 70% of GCCs in India are now leading their company's global AI mandate. India is becoming the core engine for corporate AI strategy worldwide.
But all this demand for AI infrastructure, it comes with a pretty chilling warning for global finance.
Yes, analysts are sounding the alarm. They're worried that big tech's massive debt sales, all driven by AI and data center expansion, could overwhelm buyers.
So too much supply of debt hitting the market at once.
Exactly. It's a problem called supply indigestion. Too many huge loans hitting the street, not enough buyers to absorb them without credit quality weakening.
So the very demand for capital to fund this AI arms race is creating a systemic risk in credit markets on both sides of the Atlantic.
Precisely. And analysts think this huge borrowing will continue through 2028. It really makes you ask, what is the long-term financial cost of this rapid, capital-intensive AI build-out?
A case of the debt used to build the future, maybe destabilizing the present.
It's a real risk.
Okay, finally, let's wrap up with a scientific innovation. This one could redefine a fundamental industry: agriculture. We're talking about CRISPR and wheat.
This is a genuine breakthrough from researchers at UC Davis. They've engineered wheat using CRISPR to boost a natural compound that's already in the plant.
And what does boosting this compound actually do?
It's essentially a communication signal. It encourages specific soil bacteria to form biofilms around the plant's roots.
Right.
And those bacteria then do something amazing. They convert atmospheric nitrogen, which the plant can't use, into a form of fertilizer that it can use.
Wait, so this engineered wheat is basically teaching itself to self-fertilize.
That's the monumental implication, yes.
Which would dramatically reduce our reliance on traditional energy-intensive nitrogen fertilizers.
It offers a clear roadmap to do just that. The plant is essentially outsourcing its fertilization to its microbial neighbors. This doesn't just save money, it could de-risk the entire global food supply and slash the carbon footprint of industrial agriculture. It's truly regenerative tech.
And just before you go, a quick note: this deep dive commentary is put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.